All the research houses confirm that property prices are rising around Australia and our markets have turned the corner. But what does the May interest rate hike mean for this nascent property market recovery? That's what Dr. Andrew Wilson and I discuss, and here's a spoiler alert. It doesn't seem to be having any effect at all at present. So why not subscribe to this YouTube channel so you can keep up to date each week as we have our Property Insiders chat, and then please just click the little bell icon so we can inform you each time a new show comes out. What does the rate rise mean for our housing market recovery? Of course, it's old news that the Reserve Bank raised interest rates again in May, marking 11 increases this tightening cycle and bringing the official cash rate to its highest level since April 2012. Of course, the rates you and I pay for our mortgages is much, much higher than the 3.85% official cash rate. But since the pause in interest rate hikes helped increase buyer confidence and seller confidence in April, what does this latest rate rise mean for our emerging housing market recovery? That's one of the questions I asked Dr. Andrew Wilson, Australia's leading housing economist, in this week's Property Insider chat. I'm also going to ask his thoughts on the latest housing finance numbers, as well as the booming auction results this weekend. Hi, Andrew.
Yes. Hello, Michael. And we did have a rate rise last week. I think that was about the surest bet you'd ever have. I think there's almost 100% certainty behind that. But I was astonished to find that apparently most of the banks predicted another pause. Gee whiz, those banks keep getting it wrong, don't they? Whether it's house prices, the economy, or rates. And you'd think, given their business focus and their protected species in our greater economy and our greater industrial profile, that they'd get it right, but they keep getting it wrong. And I thought it was an astonishing decision, in my opinion, by the Reserve Bank to pause rates over April. They kept telling us that they were only going to make moves based on the data. There was absolutely no sign in the data that had come out prior to that April decision that there was any easing in economic activity, that there'd been any impact from interest rates. And yet they said, we're going to wait and see, just to see if something was happening. Well, they didn't wait very long, did they, Michael? 30 days and they were back up again. This Reserve Bank really is, unfortunately, looking like it's justifying those proposals to change its structure. And I think they had to raise rates again. This economy is still booming. There are no signs, no real signs that interest rates have had any impact on the economy, particularly inflation, that even though it's falling, probably would have fell without interest rate increases, Michael, because lower inflation has been about supply starting to match demand through those surging demand forces that were driven by the COVID stimulus packages. But yes, another interest rate increase. But I think it's interesting, you mentioned where we are in terms of the historical position, but we're still nearly a percent below our previous peak, Michael, which was well into the fours back in 2011. But I do think it's interesting to note that our mortgage rates are at the same as they were when official rates were actually nearly 1% higher. So in that period, banks have actually increased their margins versus the Reserve Bank's official rate, which I think is obviously highly questionable. I think the average mortgage rate at the moment is around about 7.8% with a 3.85% official rate. We had a 4.75% official rate back in 2011, but we had the same mortgage rate, average mortgage rate of 7.8%. So no surprise that rates increased. I think we've got more to come, but the big picture is its higher rates have had no impact on the economy to this point with the data that's been revealed. And guess what, Michael? Housing markets are up and running again unambiguously. So I think, even as you mentioned, that rate pause helped that condition.
Well, we'll talk about the auction results in a moment, but clearly over the weekend, the rise in rates didn't affect buyers or sellers. But I found it interesting that the Reserve Bank's governor's statement on their rate decision said the combination of higher interest rates, cost of living pressures, and the earlier decline in housing prices is leading to a substantial slowing in household spending. That doesn't seem to be what's happening in reality, Andrew.
I'm just shaking my head, Michael. What's the evidence for that? This is a statement that doesn't reflect the data. We have a substantial slowing in household spending. I note they said the earlier decline, whereas they've put in that conditional earlier, or that descriptive word earlier decline, whereas before they were saying the decline as though it was actually happening. But even the Reserve Bank has conceded, yes, they got it wrong on house prices, and that house prices are no longer declining. But yes, look, the statement that there's a substantial slowing in household spending, well, where's the data to support that? Home prices are now rising across the board. My housing market has shown house price growth in every capital city market over the April quarter for houses, and retail spending is up again, and the trend is increasing in retail spending, which we'll discuss that data shortly. So retail spending is not only still at a very high level, the rate of growth is increasing. So as much as they try to talk this economy down, the data's just not supporting it, Michael.
Well, the chart we're showing on the screen at the moment, your chart from my housing market, shows the rise in retail spending. There was a little dip last year, wasn't there? But boy, it's picked up again.
Well, that's right. And I think the point is that the retail spending data was influenced by the November Black Friday sales. So we had a tremendous surge over Black Friday through November, which has become a real event now. A lot of people do their Christmas shopping through November now because of the sales, Black Friday sales. So what it means is we've boosted November at the expense of December. So November went through the roof, and of course December went down, and that's just that seasonal adjustment that we're now experiencing. Then we picked up again through January. Now we've got to also mention that there is some issues, and the ABS has been quite open about this with their seasonal adjustment models, because seasonal adjustment is now skewed because of COVID, and that will take some time to move away from the seasonal adjustment pattern as we get out of COVID and back to the normal seasonal aspects of measurement. And there was some, sense that, that showed that falling away in December, and then the pickup in January, that showed that this was having some impact on consumer spending. Well, that's nonsense. We're now back to the levels. You can see we're well ahead of where we were a year ago. We're certainly significantly higher than where we were pre-COVID, and there is no sign of the underlying strength of consumer spending slowing. In fact, it's accelerating because the rate of growth was higher over March compared to February, Michael.
The Reserve Bank's trying to slow consumer spending to lower inflation, and your chart here is showing that inflation has dropped, but it's still too high. It's way above where the Reserve Bank wants it, and they believe it's going to be another couple of years till 2025 before it falls into their preferred range of 2 to 3%, Andrew.
Yeah, that's right, Michael. And look, we did have the inflation adjustment downwards. That's positive that we moved from 6.9 to 6.6% in underlying inflation. But as you mentioned, the target's 2 to 3%. So we're well above the target, significantly above the target. And the Reserve Bank's predicting that we won't get it to that 3% mark until perhaps 2025-26. So that certainly must mean more interest rate increases. But I think I think the big picture is that interest rates have been offset by the fact that they are still very low historically. When we look at the historical levels, that savings levels are still reasonable. They've certainly fallen over the past year, but that's come from record levels. And of course, we've got a wages boom happening, Michael. Wages are rising at the strongest rate in over a decade, and sure to continue to rise with the shortage of labour that we do have. And of course, that's helping to offset higher interest rates. And we've come through a very significant period of house price growth, eased last year in a couple of the capitals, Melbourne, Sydney particularly, but they're now back up again. Household balance sheets are still quite healthy. And as I said, the actual impost for mortgages is being offset by higher wages. And look, not everybody has a mortgage. So it's like, and most mortgages have small balances. So these things are obviously being absorbed. And the fact that we have this shortage of labour and people are feeling good about being in demand in their workplace, they can ask for and are getting much higher wages. We're still well below any sense of having an improvement in inflation. And I think just to mention, the inflation data did show us that it was goods where the improvement in inflation had come. Goods prices had fallen, but this is part of that adjustment, as I mentioned before, between the mismatch between supply and demand that occurred through the COVID stimulus packages. But the real problem is that we're now seeing services costs rising strongly, and they're now at their highest point since the early 2000s, Michael. Services costs, and this is being fueled by higher wages driving higher prices because those higher wages have to be covered by employers who are putting up their costs. And we know that just looking at the cost of coffee and all the costs of all the bits and pieces that are rising around the place now, which have nothing to do really with that supply shortage. And as I said, I believe we would have got to a better supply position on goods prices without an interest rate increase.
Well, getting back to the property markets, one of the leading indicators are home loan approvals. Many people get their home loans approved before they go out into the market to look. And we've had an increase over the month of March, the first increase since January 2022. And Andrew, this seems to be consistent with the turn in house prices over the last couple of months.
Well, that's right, Michael. And of course, it's a leading indicator, but it's lending. Again, that's just covering the mortgage market. I think that the issue is that this is just another validation that we're seeing, a rebound in home lending, which is matching the rebound that we're getting in home prices. So, which is the pattern that we typically see. There is a little bit of a lag between the more real-time environment of prices, the way my housing market measures it, and of course that home lending data. But it is the second consecutive quarter of month of increases in home loans. The rate of increase is accelerating. It's unambiguously pointing to what we do know is a revival, a consolidating revival in our housing markets, but particularly the big two in terms of size, and that's Melbourne and Sydney.
Well, all buyer types were out there getting loans.
Yes.
Of course, there was also all those refinances, but it seems that first home buyers are back in the market despite all the negative messages we're hearing about prices cutting out so many people getting their foot on the ladder.
And we've discussed this, Michael, and it's no surprise that first home buyers are wanting to take advantage of lower prices. That's good news for them. I'm not quite sure where this commentary comes from in regard to negative focus on first home buyers. But of course, I guess it matches all the other commentary that just doesn't make sense and isn't supported by the data. But first home buyers back up. Of course, that's reflecting lower prices. They're also experiencing higher wages, Michael. And again, as we were mentioning before, the offsets for higher rates, again, is lower prices, as well as wage increases.
Yes, they've got to pay more rent, so they're wondering, Should I keep doing this?
Exactly. And that's the other significant motivating force for first home buyers coming back into the market, which I was just about to mention, is the terrible state for tenants of the rental market. And, rents are going through the roof. We'll look at details of that next week. No relief. And of course, what a motivation if you can get out of the rental market and get into your own home with wages rising and prices lower than where they were a year ago still, but who knows how long that's going to last.
Well, over the last month, people from all states went out and got home loans, but Queensland, boy, there were a lot more loans written there than elsewhere.
Yes, interesting, Michael. Of course, Queensland was the latest in terms of peaking in the price cycle, and that we know that was driven by that surge in interstate migration out of those COVID lockdown states through 2021. But as the usual, moderating forces of affordability affected that Brisbane market, particularly given the unprecedented rises in home prices that Southeast Queensland markets experienced. But I do think now that market's actually looked like it's found its trough as well, and is starting to lift off following the Sydney and Melbourne markets that have clearly lifted off over the last couple of months. So capital city housing cycles don't move typically in synchronised tandem. They follow the trends eventually, but this is just another example of that, where the Sydney market, which led the capital city markets down last year, is now leading housing markets up. And now we have signs that southeast of the Queensland market, particularly the southeast Queensland market, has found its trough and is picking up.
I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Andrew, I know last week we spoke about what was going to happen to the auction markets with interest rates rising and didn't seem to phase the markets at all this weekend, Andrew.
Well, that's an understatement, Michael. I think that we had a strengthening auction market despite rate rises. And I think the point is people talking about, well, it takes a while to get your approval, etc. Can you imagine if there was any sense of issues going forward with affordability that buyers wouldn't purchase at auction? They'd say, oh, no, I'm going to wait or whatever. And of course, not everybody is buying in relation to relying on a mortgage. It was interesting, I think, to see that not only did the rates not have an impact on the downside, we actually saw the auction market strengthen last weekend, Michael. There's a number of reasons for that. We're back to a full market because the holiday seasons of April is over. Numbers were up generally. As I said, I think that rate pause over April has worked its way into a positive to maybe outweigh any negatives that came from that increase that we had for May, that we've got now for May. But clearance rates were quite spectacular, Michael. Sydney recording its highest clearance rate in over a year, 79.8%. Still quite haven't reached that 80% mark, Michael, because we know that when we get an 80% clearance rate, we can start thinking who would believe of using the term boom, but we'll hold that one back for a little while. But gee whiz, if we get to 80, Michael, I think we've got to start thinking about that word because that is the benchmark for what we've always used for a boom is 80% because that's an 8 out of 10 chance of selling your property on the day. But Sydney, 79.8%. That's a remarkable result. Melbourne, 78%, following just a little bit lower than the previous weekend, but Melbourne's now tracking at its highest levels since late spring 2021. So these are very strong results. Brisbane, we mentioned that Brisbane housing market, Michael, had its strongest clearance rate for some time, 74.7%. Adelaide over 90%. Of course, Adelaide typically tracks in the 80s, but it had a strong weekend as well, over 90%. And the laggard Canberra had a good weekend, 75.2%, because it's been in the 50s, high 50s, really, for most of the previous month or two. So inarguably strong results, Michael. Nothing here to suggest they've just come out of the blue. It is just continuing the trend of the last couple of months. This is a reviving, strengthening, and now strong housing market that we have. It's inarguable on all the measures you want to use: prices, days on market, auction clearance rates, home loans are all pointing in the same direction. And I'm just wondering, Michael, what are all those doomsayers saying now? Even the ones that said, oh, yeah, it might have just picked up over 1 month, but you wait and see the next month, it'll be back down again. Hey, it's rising, rising, and rising at the moment. And I think that we're in for a very good second part to the autumn selling season, which is good news for sellers, but also some good news there for buyers, which I think is fertilising the market because prices are still below where they were a year ago, Michael. So that's the point. This generates fear of missing out energy because buyers are realising that, well, I can still get a value proposition at the moment because prices are lower, but there's plenty of more buyers in the marketplace I've got to compete against.
I started off our discussion by asking, will the rise in rates quell our nascent property boom? And I think very clearly you pointed out, no.
Well, we're still lower than where we were with our rate, our official rate, back in 2012, and we're 1% below that, Michael. And the other point is, of course, that wages are rising at the fastest rate in 10 years because we've run out of labour. And as long as wages are rising and people have work, and now house prices are rising again, you're going to feel pretty good about life, surely. This is probably the strongest market, labour market we've ever had in terms of, the nature of the market, how it has changed. But we've now got unemployment rates we haven't seen for maybe 2 generations. So it's quite spectacular. And this is what's clearly driving the market. And unfortunately, it needs more hard work to try to control inflation. Maybe we've got to start thinking of other options in terms of what comes next. But I thought it was instructive, Michael, last week that the US released its latest jobs data and wages data for April. A lot of the financial journalists and, economists were all saying, oh, this is going to be a terrible month. It's going to fall away significantly and wages growth will be lower and unemployment rates will be higher. Gee whiz, it's almost becoming a trend with how poorly performed these financial journalists, who I guess rely on what the economists are saying, but they do interview economists, I think, that sort of reflect their point of view anyway. But hey, they all got it wrong. Again, we had another surge in job creation in the US. We had a lower unemployment rate in the US, 3.4%, lowest since 1969. And wages rose at a faster rate over April than they did over March. So no sign of victory there in the US for inflation, but they too are experiencing very strong economic conditions.
Well, when we catch up again next week, the budget will be out. We'll see if there's any surprises for the housing market. And I look forward to getting your rental report then too. Thanks for your time, Andrew.
Yeah, thank you very much, Michael.